Hey, Jerry, are you ready for this webinar?
I think so. Good to see you again. I haven't seen you in a while.
I know, he's always got me working. I don't get much time off. How's Michigan doing in football?
Well, they're ranked up. They're in the top 10. We're going to wait to see what happens.
Jerry, how come I never get invited to Notre Dame?
We've been virtual,
Oh,
but next year we're going to go. Next year we're going to go live. Definitely.
Beautiful. Well, maybe Alan can put me in his suitcase and bring me there. I hear there's good food and a lot of nice people.
Actually, maybe we could have you give a presentation at lunchtime.
That would be great. Tell me. Jerry, did you really meet Gerald Ford?
Yeah.
What was he like?
Well, first of all, he was a Michigan graduate, so no, he was very nice because I was in a conference and I noticed that all the technical people were explaining stuff so technically, and I looked over and I saw that he wasn't really following it, so I kind of translated.
So he actually cared about the tax law?
It was he was very interested in what we were doing. Yes.
Wow. All right, here comes Alan, so you'll have to start the show. I hope it's better than last week's. All right. Welcome, Jerry. Welcome, CPA Academy attendees. Welcome, other attendees. We're here to talk about charitable remainder trusts with one of my favorite people, one of the smartest people I know, Jerry Hesh. So if you have booked in through CPA Academy, you're going to get 1 hour credit. We're going to go for about 60 minutes, and then Jerry is going to talk about the Notre Dame Tax Institute, because I know a lot of you are interested in the Institute, but we want to talk about some of the specific programs so you can make your decision as far as whether you would like to participate. If you came in through our website, there will be no continuing education credit, and you don't have to worry about the polling questions, which today will be about polls of all kinds. If you have a question today, just click on the question, the inverted pyramid, type in the question, and if we know the answer, we'll look at it and we'll answer it. If we don't know the answer, we'll pretend we did not see it. Also, don't hesitate to send any questions to info@gassmanpa.com. All right, next week, I'm going to be talking about mathematics for estate planning, and we are going to have Larry Katzenstein come and talk about Tiger Table software. And I'm going to show you a little bit of Tiger Tables today, if we have time, just to show you how Tiger Tables handles charitable remainder trusts. All you do is you open Tiger Tables, you click on Charitable, you click on Charitable Remainder Trust, and then you put in the 75/20 rate, which it will tell you for September will be 3.6%. And then I put in a life. I could do it on one life. The person might be age 70, and my contribution might be $1 million. Put in $1 million. And then I might want to get an annuity of $60,000 a year. And then I hit recalculate. And Jerry, what's it telling me? That I'm making a 5% probability of exhaustion test. So my payment is too high?
No, the annuity is too high because what'll happen is based on the life expectancy of the individual, the annuity is too high, and therefore there's a probability that when they die, when they reach their life expectancy age, nothing will be there for charity. So you have to have an annuity that has to be reduced so that, oh yeah, you see, you reduced it from 60 to 50. Now it works. See that?
So now this person puts $1 million into a charitable remainder annuity trust and is going to get $50,000 a year until the person dies, he's age 70, or until the trust runs out, and he's going to get a charitable tax deduction of $480,840.
Yeah.
Now, let's say we want to add his wife in. So we'll have 2 lives, and she is 65. And now maybe we would like the annuity to be $70,000 a year. Well, that's not going to work, but it will tell us that it doesn't work. So one of the things I really like about Larry's software is it tells you that won't work. So you go to $35,000 a year for the lifetime. Oops, 35, 1, 2, 3 for the. Oh, we'll do that. 25. Okay, $25,000 a year for their life. Oops. Now the payout must be at least 5%. So it's got to be at least 50,000. Click calculate, and there we go. It allows this a $294,000 tax deduction, even though they're going to get $50,000 a year the rest of their life. So one of the reasons I wanted to show this is because it's fairly easy to run these numbers, and it will make sure that you follow the mathematical rules. And I can say, well, what about 55,000 a year? How will that work? Will it work? And it will tell me, no, that won't work. So it needs to be a little bit less than 55, but more than 50. So then the other screen I like here is I can just go to Charitable, and I can go to Charitable Remainder Unit Trust, and now it's going to be a percentage. And it's just as simple. So a lot of professionals don't have this software, and they think that charitable remainder trusts are really complicated, and they have to go to somebody on a high and holy mountain to figure out what you can do. But really, by trial and error, using a simple software program. Jerry, how does Number Cruncher compare to this?
Number Cruncher, it takes a little bit different approach, but they do show you the exhaustion test. But what I find is that Tiger Tables gives you more information, even though they end up with the same results. So so if you're not familiar with all the obscure actuarial details, Tiger Tables teaches you more than Number Cruncher.
I'm really surprised that nobody has a free website that allows anyone to go there to run these numbers. Maybe that'll be a nice project for some law students.
All right.
Okay, so for those of you who are not tax lawyers or CPAs and don't have a slightest idea what we're talking about, I have here a charitable remainder unit trust, and I can fund it during my lifetime or upon my death, and it can pay a fixed percentage of value, like 7% a year, back to me or to my children or to my wife, and for a lifetime or 2 lifetimes. Or you could do a fixed 20 years, and then whatever's left at the end goes to charity. So
Alan?
Yes.
Alan, most of the people will do charitable remainder trusts for their life, which is great. The only thing is, they say, well, what happens if I die early? Like if I die unexpectedly before my life expectancy, and you say, well, everything in the trust goes to charity, you don't get anything else. So what we can do is you can do a charitable remainder trust for a fixed term, not to exceed 20 years, which means it's guaranteed. So if you die during the 20-year term, the remaining payments for the remainder of the 20 years, it's still an asset, you don't forfeit it. So for people who are worried about dying unexpectedly, we recommend a fixed term rather than for life.
Right. Now, you can fund a charitable remainder trust from a Dynasty trust. And if you do that, I think you need to use a term of years, and it can't be more than 20 years.
Yeah.
Okay, so the other type of charitable remainder trust, this is the Crotty, where you pay a percentage every year, and it's the same percentage of assets every year. So if the assets go up in value, your payments go up, keeps up with inflation. The Crotty is a fixed dollar amount. And one thing we like about the CRAT here in Florida is that based upon at least one bankruptcy court case, if I put $1 million in a CRAT and it pays me $50,000 a year for the rest of my life, that's an annuity, and my creditors can't touch it. So I can load this up to where I'm getting 90% of the value back or more, and that can be for my lifetime, and my creditors can't touch it. And by the way, my children can't touch it, my wife can't touch it. It's just those annual payments, and then the remainder can go to a family foundation that I can set up just before the charitable remainder trust lapses. You can use other charities until it's about to lapse. Please remember that you can always change the charity. You know, there are charities out there who encourage you to do a charitable trust, and then they'll draft it for free, and then they don't put in the provision that says you can change the charity and you can change the trustee. You could be your own trustee. Jerry, if I'm my own trustee of a CRAT or a CRUT, can I take a trustee fee on top of my annual payment?
The answer is you would otherwise have to pay a third-party trustee. So rather than pay a third-party trustee, you pay yourself. Like most people, when they are the trustee of their own charitable remainder trust, waive their trustee fees. So that means more money goes to charity. But there's no reason why, as long as it's reasonable. Don't make it unreasonable.
Okay. Good. But at least you can explain to your client the annual payment. They could get a trustee maybe 0.5%, 0.75% a year, not a huge amount, but they can get something. So this chart may be of use to you later on, where the donor puts assets into charitable remainder trust. Most often they are appreciated assets because the donor doesn't want to pay capital gains tax. It's better to give appreciated assets if you have them versus cash. And if you're about to sell a business for $1 billion, you throw that into the charitable remainder trust the day before you sign any binding contract to sell the business. Then the charitable remainder trust sells the business and you don't pay the tax for a long time. So the tax is deferred. As you get your payments, the income comes out to you, but it is deferred. So
give an example of that later.
Right.
The most important thing is when people give money to the charity, they know that they can, if they give cash to the charity, they can use the charitable deduction to offset up to 60% of their income. And that's what most people think about. When you give money to charity through a charitable remainder trust, you're not giving anything to the charity immediately, and therefore what you're giving the charity is a future interest. So it turns out that the amount of the charitable deduction from creating a charitable remainder trust that you can use to offset your income is limited to 20 or 30% of your income. So it's just a little thing that people aren't aware of.
Right. Now, in the planning world, obviously the donor gets an income tax deduction if you want one. We'll talk about that in a little while too. The donor gets the income tax deferral, and then, just so you know, if I die and I leave my wife the unitrust amount with the remainder to charity, that qualifies for the estate tax marital deduction as to her share, and it qualifies for the charitable deduction as to the charity share. The IRS just issued an opinion relating to an estate where the charitable remainder trust said, give the remainder to charity, give the unitrust interest 25% to my wife and 75% to my wife or charity, depending upon who needs it or what the trustee wants to do. So they filed an estate tax return and said 100% deduction because it's going to charity or marital. And the IRS said, no, you don't get the marital deduction on the 75% unitrust interest because you can't be sure she's going to get it. And you don't get the charitable deduction because you can't be sure the charity's going to get it. And of course, the taxpayer, I'm sure, jumped up and down and screamed, but you guys know it's going to charity or marital. And the IRS said, oops, sorry, you have to follow the rules.
It has to be guaranteed.
Has to be guaranteed, right, with with nothing that could cause it to not occur. All right, our first polling question. Here's one you haven't seen before. Which is true about pole vaulting? By the way, the answer is D, and once Brittany tells us we have 95%, we can go to the next one. So please put D. A, the pole is made of fiberglass or carbon fiber. B, it began as a medal event in the Olympics in 1896. C, they were known to the ancient Greeks as well as Cretans and Celts. So, and D is the correct answer, all of the above. We're expanding your knowledge today in ways that you never imagined possible. Are we good? Okay. Now, here is something to think about. Let's say your client established a dynasty trust, and they're paying the income tax on the trust to reduce their estate tax, and that's all good. And now the dynasty trust is going to sell an asset and have a big liquidity event. So the client could toggle off grantor trust status where the trust is taxed, but the trust is going to be in a high bracket. So the trustee of the trust could transfer the assets that are going to be sold before there's a binding agreement to what we call a flip NIMCRUT. And I don't think Jerry and I are going to get to talk much today about the flip NIMCRUT, but if you Google Gassman flip NIMCRUT YouTube, my partner Christopher Denicolo has a nice video there that you can watch. So the Dynasty Trust puts the asset into the NIMCRUT. The NIMCRUT sells the asset. The NIMCRUT, if everything's done properly and all the rules align, won't pay any tax, and the Dynasty Trust won't pay any tax, and then that NIMCRUT can hold that asset, reinvest it, typically up to 14 years, because it has to be a term of years. It can't be a lifetime term when you come off of a trust. And then after about 14 years, a huge payment based upon about 11% of the value of the NIMCRUT every year for 14 years, all building up and not taking into account what it owes in payments. So that's a huge payment in year 14. Then it converts to an 11% per year normally CRUT. 95% maybe of the assets come out to the client, to the Dynasty Trust. That's a great thing. So, Jerry, anything?
Conceptually, you have a grantor trust. You're alive, and it can be any grantor trust. And the problem is that the grantor is sick and tired of paying the income taxes on the grantor trust income. So by having the grantor trust put assets into a charitable remainder trust, number one, the trust gets a charitable deduction, which the grantor can report. But more importantly, what you're saying is using the charitable remainder trust defers the reporting of the income. And especially if you're going to sell an appreciated asset, the trust is going to sell. So the key is use the grantor trust creates a charitable remainder trust, which postpones the reporting of the income that the grantor would otherwise have been immediately taxable on.
Okay. Now, Jerry, I want to mention that if the Dynasty Trust forms the NIMCRUT, there is no gift tax deduction needed because nobody's making a gift. And if the NIMCRUT has as a permissible beneficiary a cemetery association or a police benevolent association, then the NIMCRUT will not qualify for an income tax deduction. And Jerry, what happens if you set up a NIMCRUT or a CRUT and there's no income tax deduction and there's no gift tax deduction at the inception?
It still works for income tax deferral.
Still, it works for income tax deferral, and it is not subject to the related partner. So then the clients could borrow money from the NIMCRUT at arm's length, pay no more or no less than arm's length, get a very careful determination. and then that they could invest that money in a business that might pay that NIMCRUT a tax deductible interest. So the NIMCRUT sells the asset for 10 million. No one pays income tax on that. The 10 million is loaned in a secured loan at a reasonable interest rate to the family business, or to another family business. The family business is deducting the interest paid to the NIMCRUT. Now, this is in the statute. This is not made up somewhere. This is in the statute. But the IRS is not willing to rule on any particular situation. I can see why they don't like it, but nevertheless, it's interesting. Now, Jerry, let me go a different direction. First, the family forms a NIMCRUT. They put $5 million worth of investments in the NIMCRUT. The NIMCRUT is a flip NIMCRUT, so they're going to get, over 20 years, they're going to get 90–95%, we hope, of the value back. Now, this unit trust interest that they're owed, is that something that they could now donate to a Dynasty trust? And how would you value it if you could?
Well, in effect, what you're saying here is they retained an interest in a charitable remainder trust. That is an asset. And basically, it is a very valuable asset that is going to produce income in over a long period of time. And it might, and the amount of distributions it will produce over a long period of time are expected to increase in value. So what you have is a retained interest in a charitable remainder trust, and it's a variable asset. So why don't you do your own estate planning with that retained interest? So Alan is basically saying, conceptually, you have an asset, rather than have it included in your gross estate, do some kind of estate planning with it.
What would the discount be? Let's say, Jerry, that I put $4 million into a flip NIMCRUT. It's going to pay me 11%, but I may not get the first dollar for 14 years. So 90% of 4 million is 3.6 million. Is it worth 3.6 million when I transfer it to the Dynasty Trust, or what would a valuation firm say that interest is worth?
Well, they would take into account that the distribution may be deferred, and and basically any kind of asset you have where you know you're going to get income, but there's a possibility it could be deferred, that has to be taken into account, because a dollar today is worth more than a dollar tomorrow.
Right. Okay, so Jerry, let's get to your first example, which I think will really help us burn in how it works.
All right. So one of the interesting things is a charitable remainder trust doesn't pay any income tax on its income. It reports its income, but it's not subject to tax. So if the charitable remainder trust has income, that income is only taxable when it's distributed to the individual who holds the unit trust or annuity interest. So the charitable remainder trust can earn income currently, but it's only taxable when it's distributed in the future to the holder of the lead interest. So we are actually using charitable remainder trusts as a way to defer the reporting of income that was earned today, but is not distributed to you until future years. That's the concept behind charitable remainder trusts. So the problem is, how do you explain that to a potential client in an understandable manner? And we can describe it. We can use terms like NIMCRUTs, unitrusts, annuity trusts, and that's not in the dictionary. And the client says, "What's a NIMCRUT? What's the difference?" And as soon as you start to try to explain the technical differences, I can guarantee you that the client's attention span will wane. So the key here is really to, instead of trying to technically explain it, is use numerical examples to illustrate it so that the client can visualize it. So that's what we're going to do here, okay? So we have an individual, and all my individuals are senior, mainly because I can't remember names without a seating chart, okay? All right, so senior is 65 years old and has stock in a public company worth $10 million. And senior was a founder of this company or was an investor in this company when it first started up. So their cost basis is close to zero. Okay. Now, if senior would sell that stock for $10 million of cash, there would be a $10 million capital gain. And senior would have to pay income taxes on that capital gain at the federal rate and state rate. So that it's not unusual that the income tax combined rate would be 30%, and he would have only $7 million. So the key here is I would like to defer the reporting of that capital gain, even though the charitable remainder trust sells it and has $10 million to invest. So let's suppose that senior creates a charitable remainder trust and contributes depreciated marketable securities to the trust, retaining a what do we call a unitrust interest. And based on senior's age, the maximum percentage that senior can receive is 19% of the value of the trust assets. So what that means is if senior contributes the $10 million asset to the charitable remainder trust, the distribution that senior is entitled to receive at the end of the first year is 19% times the 10 million. Okay, so he contributes the asset to the charitable remainder trust sells it, has $10 million to invest. So right away, senior is entitled to the income from 10 million, whereas if senior sold it and paid the 3 million of tax, senior would only have the income from 7 million. So right away, by deferring the payment of tax, there's more principal to pay income to senior. Secondly, because it's a charitable remainder trust, senior is going to get a charitable deduction immediately. And because we're maximizing what senior can take out, the charitable deduction will be 10% of the 10 million. So senior gets a $1 million immediate charitable income tax deduction, was going to be being able to get the income from 10 million in the beginning instead of the income from 7 million. And when the capital gain is reported, it's going to be reported by senior in the future as he receives these future distributions. So let's illustrate that. Okay. Okay. All right. All right. So let's suppose in the first year, the 10 million earns $500,000. That's a hell of a lot more than getting a rate of return on 7 million. All right. But the distribution is 19%. So senior is going to receive a distribution of 1,951,000. So how is that distribution of 1,951,000 treated? Well, 500,000 is the income the 10 million earned in the first year, and the rest of it is depleting trust principal. And in trust principal was that 10 million of capital gain. So the remaining portion is capital gain. So look at the next chart and we see how this works. Okay. So this just shows you that senior would, if he sold the stock, would have 7 million to invest instead of 10 million. All right, next slide. Okay. All right. Okay, so we just went through all this. Next slide. Okay. All right. So the key here is, now this is something interesting. The charitable deduction is based on when senior is expected to die. And the IRS is required to use mortality tables, and says senior has a life expectancy under these mortality tables of 17.8 years. So senior is getting a charitable deduction on the assumption that senior will die exactly 17.8 years from now. But these mortality tables are 22 years old, okay? And there's also, the mortality tables mean that senior with a life expectancy of 17.8 years, there's a 50% probability senior will still be alive at the end of that life expectancy. So what you really do is you have to look at realistically how long senior will live. So see, if an insurance company said he's going to live an additional 10 years to 93, which is not unreasonable, the charitable deduction is overstated. And also what this means is if the amount that goes to charity will be significantly reduced, as the next table will illustrate. Okay. All right, so here's the first year. Senior has $10 million into the charitable remainder trust. So the trust can earn, let's assume it earns 5%. So the trust can earn 5% on 10 million, not 5% on 7 million. So what happens in this situation, interesting, is the 1.9 million distribution is going to consist of 500,000 of the income that was earned, and the excess of 1,451,000 is the capital gain. So remember, there was a $10 million capital gain, and all we're doing is deferring the reporting of this capital gain. So what you see is out of the 10 million capital gain, where the trust has the use of all 10 million, you only report 1.4 million. Now, the way the unit trust works, it's a percentage of the value of the trust principal at the beginning of each year. So what that means, it's going to be 19% times 8.5 million, or basically 1,666,000, because we've depleted trust principal. Also, we got less trust principal, so the income is going to be on 5% of 8.5 million. So the second year payment is going to be 1,668,000, of which 427 is the income the trust earns, and what's left is the trust principal, which is the capital gain. So let's look what happens each and every year. We're evading principal, so the principal goes down, so the income is less, and the unit trust percentage is on a floating amount each and every year. So look what happens at the end of 11 years. Now remember, senior got a $1 million charitable income tax deduction up front immediately. So at the end of 11 years, senior has basically received about $8.2 million of the capital gain, which is an income tax deferred, okay? And if senior died in year 11, whatever is left in the trust, 1.7 million, would go to charity. So senior has only received about 8.2 million of the capital gain. But senior, this is senior 65. 11 years from now, senior is 76. The only advantage of senior getting to be 76 is if he plays pickleball, he can then be advanced into the 75-year-olds. And when senior reaches 80, they'll be in the new pickleball pool. You didn't know pickleball has advanced ages. All right.
Wow.
So that's just an extra little tidbit. Sorry, I get distracted. So, but let's look what happens. Senior is going to, we expect senior, next slide. We expect senior, oh, want to do the polling question, Alan?
No, let's stay on this.
All right. So here's what's interesting. Remember, senior has a life expectancy of about 18 years. And there's a 50% probability senior will still be alive. But look what happens in this situation. If at year 18, senior has received about $9,400,000 of the trust principal and reported that amount of capital gain. Now remember, if senior died at 18 years, exactly at their life expectancy age, they still got the 1 million charitable deduction. But look what goes to charity, 600,000. Would senior like a $1 million charitable deduction today for only 600,000 that goes to charity at the end of year 18? But remember, the insurance company says, we looked at senior's health. We think he's going to live another 27 years. Well, guess what? The IRS tables all assume he's going to exactly die at the 17.8 year life expectancy age. So what we're really doing is arbitraging the mortality assumptions, because the mortality assumptions assume senior is going to die exactly at 17.8 years, and that's what the charitable deduction is. But you can basically, if you live longer, senior dies at 93 years old, basically got 9.855 of all the capital gain back, and only $144,000 goes to charity. So the charitable remainder trust, this isn't even the NIMCRUT, this is just a regular straight charitable remainder uni trust, is a way of doing three things: generating an immediate charitable income tax deduction for 10% of the value going in, having the before tax proceeds available to produce income, and the capital gain that the charitable remainder trust realizes when it sells the 10 million of asset. Instead of senior having to report the entire 10 million capital gain, they report it over their remaining life. It's front loaded. But with those advantages, senior will be better off with the charitable deduction, the increased principal amount earning income, and the deferral of the capital gain than if senior sold the asset.
Beautiful. Beautiful. Okay, now we'll go to the polling question. Which of these facts about Poland is true? And the answer is D, all of the above. A, Poland is one of the world's oldest salt mines, has one of them. B, vodka originated in Poland. C, Poles enjoy drinking beer with fruit syrup. I'm sure not all of them.
Syrup, you've got to be kidding.
That sounds pretty good, really. It's pretty good with tomatoes. Or D, all of the above. Now, I'm sure C is not for all Poles, but maybe at least 3 or 4 of them.
Okay.
All right. Thank you for answering that. Okay, so page 44 is from a presentation that I recently gave. And what I want you to think about if you're an advisor is that there's 5 legs to the table to have a client very comfortable making a charitable structure. The first one is the cause benefit. The second is the tax savings. The third is whether they want recognition. The fourth is who has to give them permission and what their motivation will be. And then the fifth is people want to retain control. So my client can be the trustee of that charitable remainder trust. And when he dies, it can go to the foundation that he's established. And then what people want is they want a sense of security. If I give it away, I may need it. Well, with a charitable remainder trust, at least you have that annual income interest, and it may be creditor proof as well. So it may provide more security than the assets without security. Then I've got just some other slides. I put Jerry's picture in honor of the charitable remainder unit trust in my slides. And then just want to mention a few things about CRUTs. And these next 6 slides cover a lot of things about a lot of entities, but a CRUT is subject to the unrelated business tax, and it's at the 100% bracket. So partnership don't work well if they shoot off income. And
can I put my operating business in a charitable remainder trust?
if it's under a C corporation, you can. But directly
creates double tax.
Well, yeah, it does. But I don't know of any other way to put an operating business in a CRUT. Now, you could put a triple net lease business, you know, if you have property that you're triple net leasing, rent income, and it's not percentage of profit rent, that can go in a CRT very easily. Unless there's debt, then you have issues.
So basically, I can't put an operating business directly in a charitable remainder trust unless I create a C corporation, which means all that the trust gets is dividends. But interesting, you have an operating business that has its own plant and equipment. And so what you do is you bifurcate the building and the equipment from the operating business. You put the building and equipment in a separate entity, and the operating business pays rent to the entity that owns the plant and equipment. In other words, you create a lease. So now what you're telling me is passive lease payments, because you don't have to do anything, is not unrelated business taxable income. So you can basically shift what would otherwise have been the profits from the business to a leasing company that leases its equipment back to the operating business. You put the leasing company in the charitable remainder trust, and you don't have UBIT.
That's right. Yeah, thank you for thinking of that. Okay, a charitable remainder trust can own partnership interest, but that K1 income is going to be taxed at the 100% bracket. So you want to be careful about that. A charitable remainder trust cannot own S corporation stock. So clients came to me last week and said, we just got a great offer for our business. It's owned by an S corp. Can we put our S corp stock in? No. You could have the S corp put not substantially all, but a lot of its assets in a CRUT or a CRUT, and then have the CRUT sell, and then the unit trust interest goes up to the S corp. So the shareholders of the S corp are tied to the hip for 20 years. So it's doable, but it's a square peg in a round hole often. The C corp works very well because the dividends that come out of the C corp that go to the CRUT are not taxable until the money comes out to the unit trust holder. And by the way, the money comes out worst first. So to the extent that the CRUT has ordinary income, that comes out first. Then capital gains income can come out after ordinary income. And there's 5 tiers of income.
Yeah, but dividends are in the first tier. And the reason they were in the first tier was because dividends used to be taxable as ordinary income. Now, dividends are qualified dividends are taxable at the capital gains rate, but dividends are still in the first tier. So you can actually conduit out dividend income as the earnings, and it being tier 1. So it's not worse. It doesn't have the worst tanked anymore.
Right. So then, as we said on the self-dealing rules, and the excess business holding rules will apply to a CRUT, but you can avoid the self-dealing rules by having a CRUT funded by an irrevocable trust and put a police benevolent association in there as a potential beneficiary. Don't take a gift tax. You won't need a gift tax deduction. You won't receive an income tax deduction. And then if the client needs to borrow money from the CRUT at arm's length, well secured, they should be able to do that. So here is our third, also known as the second only question. Pick your gift, whether you want a gift or not. A color picture of Jerry's Triumph and motorcycle. And the Triumph doesn't have air conditioning. So if you're ever down in Miami on a hot afternoon, you want to go on a ride, Jerry will come get you in the Triumph. B, my beta book is coming along pretty well on charitable planning. C, a corrupted artery test or spinal tap. your choice, or D, none of the above. So hopefully on this answer, in this question, the answer is A or B. Brittany, everybody's thinking? Okay. Now, I want to just mention that an IRA can be payable to a charitable remainder unit trust. Nowadays, you die, your children are a trust for your children, have to pull it out within 10 years. You can leave it to a charitable remainder unit trust that's going to go 90% or more to your children or grandchildren, and then they can get at least a 14-year deferral, if not longer, using a NIMCRUT. So what you could do is have the IRA go to a trust for the child, but then the trustee of the trust for the child could disclaim it within 9 months of death to a charitable remainder trust. So just wanted to bring that up, and we have slides on it, as you can imagine. Let me just go ahead and do the last polling question for the CPAs who might want to leave at 50 minutes. And if you leave before then, I won't tell anyone, but Jerry might have to since he's a law professor. Would you like to subscribe to the Thursday report? This is a free report that we send out sometimes on Thursdays, and it's not very good, but some people do read it. So A, yes. B, I already do. C, I'd rather have a spinal tap. And thank you for laughing at my jokes. Okay. So Jerry, I want to make sure that you can cover, we've got 14 minutes. Does that give you enough time to cover the termination of a charitable remainder trust?
Yes. What's interesting is a lot of people have created charitable remainder trusts while they're alive. They're still alive and healthy. And they say, you know, if I continue with the charitable remainder trust, what basically the charitable remainder trust earns ordinary income. And I can get that income for the rest of my life, and it's ordinary income. But I would really like to give the money to the charity today for one reason or another. And we can do that by terminating the charitable remainder trust early. But what the charity gets is nothing more than the present value of the right to receive whatever the trust principal is in the future, and the individual gets back. But what's interesting is the key is if the individual continues to receive the income from the charitable remainder trust, it's all taxable. And most of it will be taxable as ordinary income. With an early termination of a charitable remainder trust, the individual can get the present value of that future income stream, and part of it be a tax-free return of basis, or all of it be a tax-free basis. And if there is any income to report, it can all be taxable as a capital gain. So early termination of a charitable remainder trust basically can put you in a more favorable income tax position than continuing to receive the income from the charitable remainder trust for the rest of your life. And the charities will like it because they're getting their money today instead of far in the future. And you can indicate to the charity you're thinking about it. And of course, the charity will then invite you out to lunch to convince you to terminate it early. So let's see how this works with a simple example, okay? Because a lot of charitable remainder trusts were funded with either cash or assets like a bond in our situation. And so senior has a corporate bond with $1 million basis and $1 million value. He contributed that corporate bond to a charitable remainder trust for senior's life, and the bond pays 5% annual interest. And senior received retain the right to receive an amount equal to 5% of the value of the trust principal. Well, it's a unitrust, and if it's 5% of the trust principal of $1 million, that's $50,000 a year, which coincidentally is exactly equal to the interest income the bond is receiving. Okay, so senior has been going along reporting the interest income every year as ordinary income, and basically we're going to show senior that if he terminates the charitable remainder trust early, he can actually be in a much better after-tax financial position than continuing to receive the $50,000 a year. Okay, so, and by the way, the value of the interests in a trust, the value of the unitrust interest and the value of the remainder interest, the Internal Revenue Code provides a mechanical rule on exactly how that value is determined. So let's assume senior has a combined federal and state income tax rate of 45% on ordinary income and 28.8% on capital gains. Now, wait a minute. We all thought capital gains is taxable at a 20% rate. The answer is that's the regular tax. But if it's a passive investment, there's a 3.8% surcharge on your capital gains. So the federal rate on capital gains, if you're in a high enough income tax bracket, can be 23.8%. And then you're in a state with a state income tax. Now, we live in Florida, so we don't have to worry about that. But if the average state income tax rate is about 5%. So let's see what happens. Go on to the next slide. Okay. Okay. Now, remember that the mortality tables assume a life expectancy far less than the individual's life expectancy. So we have to take it into account. As a matter of fact, even under the mortality tables, there's a 50% probability you'll still be alive at your life expectancy. And if you look at those mortality tables, there's a 36% probability that someone age 75 will still be alive at age 90. So you have to take into account that the mortality tables assume a much lower life expectancy than what is realistic. So let's go on. Next slide. Okay. All right. So basically, we have to understand when you evaluate this, you have to take into account your realistic life expectancy, not the life expectancy under the mortality table. All right. So let's see how this all works. Okay. Okay. Oh, by the way, the mortality tables that we're using are the 2000 census data. The IRS was supposed to adopt the 2010 mortality tables over 3 years ago. And unfortunately, the CDC didn't give the IRS the census data until 2020. The IRS finally issued proposed regulations that are adopting the 2010 mortality tables, and we expect them to be available and finalized by the end of the year. And next week, Larry Katzenstein will explain a little bit more about that. So let's go on now. Okay. Okay. Senior wants to terminate the trust early. Now, what is not well understood is the Section 7520 rate, the discount rate, only applies to annuity trusts, not unitrusts. And we take advantage of this, as we'll see, because the unitrust rate is what is assumed as the discount rate, which can be advantageous. All right, so let's look at an example. Next slide. Okay. All right. Let's suppose that senior's asset contributed to the trust was a $1 million bond with a 1 million basis. Okay. Now, if we look at the tables and you wanted to terminate that trust early, the tables will show you that the unitrust interest, the present value of your unitrust interest is equal to 39% of the entire trust principal, which means about 61% of the trust principal. Okay, now, okay.
Next.
So basically, Alan?
Yep.
Okay, so here's what happens is, oh, no, go back. Okay. Okay. Now, here's the key, is when you terminate a trust early, you allocate the basis of the trust assets between the unitrust interest and the remainder interest. So what happens here is, if my basis in the trust principal of $1 million happens to be $1 million, I can basically say that $396,000 of my distribution on the early termination is return on basis. So by terminating the trust early, and the trust has a high basis in its trust principal, you're getting the present value of what would have been the right to receive future ordinary income, but the entire $396,000 will be an income tax-free return of basis. And so that $396,000 is nothing more than the present value of the right to receive $50,000 a year of ordinary income. And if you continued the trust and you received $15,000 of ordinary income, you would pay taxes on it. So you're getting the same present value amount, but it's all an income tax-free return of basis. Now, if the trust principal happened to be worth $1 million and the basis had only been $400,000, you can only treat 39% of 400,000. So basically, out of that 396, which represents the present value of the right to receive 50,000 of ordinary income for your life, I can still allocate basis to it. So out of that 396, 140 is a tax-free return of basis, and the rest. But look at this. Instead of it being ordinary income, it's capital gain.
Wow.
So by taking it early and converting the present value of the right to receive ordinary income into a capital gain. So even if the basis in the trust asset was zero, the entire 396,000, which is the present value of the right to receive future ordinary income, is automatically converted to capital gains. So that is the advantage of terminating a charitable remainder trust early. That's the tax and financial advantage. And of course, what happens in this situation is the charity gets their money early. Now, here's something that I have to warn you about. There are companies out there that will buy your unitrust interest for you. And they will basically say, under the tables, your unitrust interest is worth $396,000, and we will give you $396,000 for your unitrust interest. And they say it's great because the present value of the right to receive $50,000 a year of ordinary income is $396. We're going to buy it from you for $396 of cash, and you can treat it all as capital gain. You can't allocate any basis to the lead interest if the trust continues. You can only do that if you completely terminate the trust. So when they come to you and say, we're going to we're going to give you 396, which is the present value of your right to future ordinary income. And it's all going to be capital gain. You think that's wonderful. But if there's basis in the trust, you could terminate the trust early, so all or a portion of that unit trust amount that you receive can be a tax-free return of basis. So when you are thinking of terminating the trust early or selling your lead interest, you have to run the numbers to see whether you'd be better off terminating the trust early, which the charity likes, because if you sell your lead interest, the trust continues and the charity basically doesn't get anything until you die. So all I wanted to show you here is very simple. Go on to the next slide. Okay. Here is a little chart that basically says if your unit trust interest was worth 39% of $1 million, and you had $1 million basis in the trust principal, the entire amount will be a tax-free return of basis and no gain, which is actually very good. If the basis is only a portion of the 1 million, only a portion of the amount you receive will be capital gain, and the rest will be a return of basis. And if your basis is 0, then it'll all be capital gain. So that's all I wanted to do, is show you this comparison chart. And the key is, before you make a decision, run the numbers for the different alternatives.
Wow, that's fantastic. And we ended on time. So all of you who joined us from CPA Academy, thank you for joining us. You don't have to stick around any longer. But Jerry, now I want to talk about the Notre Dame Tax Institute. And because we have a lot of tax professionals here, and also, by the way, I had 4 or 5 of my clients attend your institute last year, and they loved it because they had never heard these great speakers before. And they had just watched maybe 6 or 8 of my Saturday 11 a.m. talks, and they felt, they got a lot out of it. So you might consider having a lessons section.
One of the things we tried to do with Notre Dame, and by the way, because of health concerns, we decided to make it all virtual this year. So you won't be able to go on the Thursday and Friday in South Bend and stay over for a home football game. But next year, we're going to go back to live. But what we like to do at Notre Dame is have presentations that not only tell you about all the latest and greatest, but the presenters explain it in an understandable manner. And we also like to have topics that you don't see at other programs. And if you look at, for example, suppose you have a family business and none of your children are interested in the family business. And the family business is only worth $15 million. So the problem is, if it's only worth 15 million, there's no estate tax, so there's no estate planning to do. But none of your children are interested in the family business. Is there a way of passing on the family business to your key employees and still keep the value of your family business in a manner that it can be given to your children and get an income tax-free step up in basis at death? In other words, can you have your cake and eat it too? And we have two programs designed to show how you can give your children an interest in the family business and still pass on the operations and ownership of the family business to your key employees who you want to take over the family business. Very practical topics that have nothing to do with saving estate taxes, but deal with practical situations that arise in the future. We're also going to show you that when you have a buyout agreement, with third parties, that there's a very efficient way to fund the buyout agreement with fewer life insurance policies by having the life insurance owned in a separate entity. And Ed Morrow is going to talk about that as well. And then we're going to basically have some programs that are going to do the financial analysis. In other words, instead of just lecturing on it, they're going to show you similar stuff to what we did today in some of our numerical illustrations. So I'm promoting my own program, and I'm entitled to do so. And hopefully, and the information for the brochure and the online registration link is all there for anybody who's interested. But the nice thing about Notre Dame is there's no way you're going to sit in front of a computer screen for 8 hours and listen to all the programs. Your attention span is not going to be that great. So what we do is we record all the sessions and we make the recordings available to you for the next 4 to 6 months on our secure website, so that if you don't listen to everything on the 2.5 days of the virtual program, you have access to all the recordings the next 4 to 6 months. That's it. Oh, here we go.
I'm sorry, I didn't realize my audio was off. I apologize. So what I was saying was a few of my non-tax and law clients attended last year, and they really enjoyed John Porter's presentation on how the IRS approaches income and estate tax issues. And I know that they'll enjoy, a lot of these other presentations. Jerry, we're going to now show the audience the video that you and I filmed about Philip Heckerling and your experiences with legal education and Philip Heckerling. But before I shift to that, are there any things you want to mention that come to mind with respect to Charitable Remainder Trust or Notre Dame? And would you like to join me this coming Saturday with Larry Katzenstein to talk about financial calculations, mathematics of estate planning, and tiger tax?
Oh, I look. Larry was sort of a math major in college. So basically, he's just doing what he was trained to do. And it's always very interesting because Larry gives you all of these financial and actuarial insights that you don't see when you just look at raw tables.
Right. Okay. So, Jerry, thank you so much for leading this presentation. I always learn something new anytime we work together. Brittany, thank you for playing the video that you're about to play. And thanks to everybody for attending this session. If you have any questions, you can email me or Jerry, and we'll be glad to answer them. Thank you very much and have a great rest of your weekend. Hi, I'm Alan Gassman, and I want to thank Interactive Legal for letting us use their studio here at the Heckerling Institute. I'm here with one of my favorite people, Professor Jerry Hesch. And for many years, Jerry has been telling me about how amazing Phil Heckerling was in so many different ways, and how many tens of thousands of lives have been changed because of what Phil Heckerling did, what he believed, and how he communicated. So I asked Jerry to come here to the studio to talk about how the Phil experience occurred and how we can all learn from that. So Jerry, can you tell us first, when did you first meet Phil Heckerling? Tell us about that event.
Well, I was teaching in upstate New York at the time. Union University had a law school in upstate New York, and actually Union University at that time was very famous because that was the campus that they filmed Love Story at.
Oh.
It's a little trivia. But in any event, I was speaking at a conference in New York City on partnership tax. And after the conference, this gentleman comes up and says, "Hesch, you're pretty good." I said, "Who are you?" He said, "I'm Phil Heckerling from the University of Miami," in his gruff voice. And I said, "Oh, pleased to meet you," and everything. He said, "You know, you're pretty good." And I said, "Why?" He said, "I don't know a thing about partnership tax. And normally I was expecting to fall asleep. But you actually explained it in a way that I really understood it. And I really like the way you present." I said, "Well, I'm a teacher. That's what I'm supposed to do. You know, I'm teaching basic income tax to the fine arts majors of the world. You got to be able to communicate. It's not what you know." So Phil said, "Would you be interested in becoming a visiting professor at the University of Miami Law School?" And I'm thinking, hey, wait a minute. I grew up in upstate New York. I went to school out in the Midwest. Who the hell wants to go to Miami? So I wasn't terribly interested, but he kept pestering me, and I'll get into that story later. But Phil liked the fact that I was able to take very complex subjects and deduce them into a very understandable manner. And it all came from one thing, and this is what Phil liked about me, and this is what Phil always wanted people in the profession to understand, is we have a statutory regime, the Internal Revenue Code, and regulations that interpret a statute. And Phil's philosophy was the Internal Revenue Code is nothing more than codifying fundamental principles of income taxation and transfer taxation. And the key should be not what does the statute say. Don't look at the code and regs first. What are the fundamental principles? And once you communicate the fundamental principles in an understandable manner without using technical terms, the idea is then people will understand the concepts. Then and only then do you look at the code and regs to see how these principles are codified and interpreted. That was Phil's educational goal, one of his educational goals in what ended up being the University of Miami Estate Planning Institute. It wasn't named the Heckerling until several years after Phil passed away at an early age, at age 62, from cancer. So that's how I first met Phil. And we'll get more into how I ended up on the Miami faculty later.
So how did the Institute start?
Well, actually, the first thing is, how did Phil end up in Miami? Phil was born and bred in Brooklyn, New York. And everybody always said you could take Phil out of Brooklyn, but you couldn't take the Brooklyn out of Phil. During World War II, Phil got drafted, and his training was in Miami, because that's where they were training everybody. And during World War II, Phil was stationed in Miami. And at that time, he had just married Ruth, and they had 2 little kids. And Ruth loved the fact that she didn't have to put the kids into winter clothes. They could let them out. They could go outside, and instead of being in the snow. They would jump in the pool. So after World War II ended, Phil went back to New York and and finished up law school. And Ruth was always complaining about, why are we living in New York when we could be living in Miami? And so she kept hawking him, and he finally said, okay, we're moving to Miami. And so that is how Phil ended up in Miami, was because he got used to living in Miami during World War II, and they eventually moved to Miami. And when Phil moved to Miami, he was like a recent law school graduate, and he was always interested in what I call family planning. We didn't call it estate planning at that time. They called it family planning. And he ended up practicing law for a law firm. And Phil always was so intellectually curious that he never had enough billable hours. So he eventually got a job with a local Miami bank that had a big trust department. And Phil became their chief trust officer. And as the years went by, Phil, in order to promote business, started to have local educational meetings for the local lawyers and insurance people and financial advisors at his bank's facilities. He started this, I think, in the late 1950s and the early 1960s. And it was a nice way to, so he would bring in local lawyers to use his trust company and everything. And it was going over very well. And every year they started getting more and more people. And every year, as word got around, it started to attract people from not just Miami, but throughout the state. People would actually come down to Miami for these local programs that Phil's bank was having. And one time in the 1960s, and Phil was always going to CLE programs around the country, mainly to get ideas, because Phil was always learning. He said the only way you can learn, nobody creates stuff by themselves. Phil said, I never came up with an original idea myself. I always read and listened. He was a voracious reader. He would have journals and articles all over the place. And this is where, before photocopying, it was on these wet sheets and everything. And he attended a continuing education program in New York City. And he listened to some guy do current developments by the name of Richard Covey. And Richard Covey, during current developments, had this massive outline on current developments. And Phil said, this guy is amazing. So he invited Richard Covey down to speak at his local programs. Now, what it was interesting is, during the 1960s, snowbirds would come to Miami for Christmas vacation, and as soon as New Year's came, they would go back to New York and other places, after vacation, and then they would come back for the rest of the season in mid-January. And so what happened is, all the hotels in Miami between New Year's Day and the middle of January were half empty.
Oh, that's really interesting.
So Phil got the idea is, since all these hotels had these half empty rooms between like January 1st and January 20th, he started to put it all together. Also, he noticed that every once in a while at his lower programs, his local programs, there were always people from Minnesota there, in the winter. He said, why are you here in Minnesota? You're from Minnesota. Why are you coming to a program in Miami? He said, because it's cold in Minnesota. So he put it all together. And he essentially said the hotels are empty in this period, so you can get really cheap hotel rates, because they're filling empty rooms. There were lawyers from Minnesota and other winter states that would love to come to Miami, between, the first 2 weeks in January. And where else could they have a vacation week in Miami and take a deduction for it?
Right.
So the first institute was in 1966. And it was not that big, and it was. But let me get into a little bit background, because Phil always wanted to become a teacher. He loved teaching. He loved the intellectual exercises and the ability to read. If Phil once said to me that if he wasn't a tax lawyer, a estate planning lawyer, he would have become a rabbi to study the Talmud. Okay? I guess it's the same kind of study. So what Phil did is he wanted to go into teaching, but he didn't have what he thought were the credentials for teaching. So he took a leave of absence from his bank, schlepped everybody up to New York, and went to the NYU LM program full time. And Ruth said, "We're going back to New York for a year in the winter." Phil said, "Don't worry, we'll come back." Okay. So, but there's one funny story, because Phil had a habit of bothering all his professors. And he never accepted anything for granted. He would always ask the professor, "What did you mean by that?" Or "What's your authority for that?" And one day, one of his professors made a statement in class that Phil questioned. And he wasn't sure, so he went back into the tax management portfolios, which had just been started at that time, and learned from reading this portfolio in the early days of the portfolios that the professor made a mistake. So he went back to class the next day with the portfolio in hand and said to the professor, "Here's the authority for your statement." And they got into a big argument, of course, and the professor said, "What are you? You're just a little pisher from Brooklyn. I can't mention the name of the professor because everybody would know him. But you can imagine by the reference who it was. And so the professor happened to be friends with Leonard Silverstein, who was the founder of tax management and developed all the portfolios. So the professor went back, called up Leonard Silverstein, and Leonard Silverstein listened to the professor and said, "Phil's right. My portfolio is right." So, but basically it's right there in the portfolio. So essentially, Phil went back, so he now had the LLM degree from NYU. And at that time, it was Jerry Wallace's program. The founders of the NYU Tax Institute were Jerry Wallace and Jack Bierman. And I think they founded the institute in 1947 or 1948. Okay? So with an LLM in tax and a moderately successful trust company CLE program, Phil approached the dean of the University of Miami Law School at that time, this was before Soyomechikov became dean. At that time, the dean was Fred Lewis was the dean. And he approached Fred Lewis and said, "Listen, right now, trust and estates is being taught by some adjunct professor. I want to come to teach trust and estates." And he explained to Fred Lewis the vision he had for an estate planning institute. Because all the other CLE programs, if you went to the NYU Tax Institute, was 5 days. They spent 1 day on trusts and estates. You go to Southern Federal, 1 day on trusts and estates. All the programs, trusts and estates was like a throwaway. And Phil convinced Fred Lewis that Miami could be in the forefront of really developing a burgeoning area, especially, you have to remember at the time that the people who came back from World War II and started businesses were, by the 1960s, started to accumulate wealth. And Phil was part of that generation. He understood that generation, and he said they need that advice, but we have to train that profession. Now, at that time, the University of Miami had an LM program in pure taxation, which was an old line program. As a matter of fact, at that time, there were only 2 tax LM programs in the country, NYU and the University of Miami. And Fred Lewis said, "But why do we need a separate estate planning program?" I'll get into how he formed the LM program in estate planning, because that was formed in 1976. And so Phil convinced Fred Lewis that we need this institute. And of course, Fred thought, it'll make money. Oh, good idea. So Phil was hired and was given the authority to start the University of Miami Institute on Estate Planning. And the first institute was in 1966, coincidentally, the first week in January. And it turned out over that Christmas vacation, they had a huge snowstorm and the Midwest was freezing cold. So the first thing Phil had to do was get a hotel. And at that time, the Fontainebleau Hotel was too fancy a place for Phil's crowd, to be honest with you. I think they wanted $80 a night for a room in 1966.
That's a lot of money in 1966.
Yeah. So what Phil did, Marty Kaufman, who was a family friend, who was a friend of Phil's, I think Marty's kids and his kids were the same age, so that's how he knew it. Marty Kaufman was the manager of the Sheraton Bell Harbor. So he went up to Marty Kaufman, and on a handshake, they negotiated a contract so Phil would have the first institute in 1966 at the Sheraton Bell Harbor. Okay, but Phil realized he needed more than just Miami in the winter, cheap vacation. So he basically had to reach out to big names that would attract people. And in those days, there was no Jeff Pennell. All there was Pennell Sr. Jeff's father was a very famous tax law professor who was famous for partnership tax.
Great treatise.
Was one of the most famous tax lawyers in the country. And that's why Jeff went into estate planning. Oops. But in any event, so Phil said I needed more than just Covey, because Covey wasn't very well known outside of New York City at that time. So he reached out to national leaders in the estate planning profession. And the first few institutes included Ed Schlesinger, Renee Wormser, Ed Hallback, John O'Byrne, and then there was this young professor at the University of Texas that Phil liked. His name was Stan Johansson, so he has Stan Johansson, and then he said there's this other practitioner I really like, Burl Abbin, and then there were a few people. They said I need some youngsters as well. So there was a professor at Washington University in Seattle, John Price. And then there was this young lawyer in Seattle he also liked. So he wanted some youngsters on the program, so he got somebody by the name of Mal Moore and John Price.
That's amazing talent.
Yeah.
That is amazing
And this is what Phil assembled, which was fantastic. And then there were some other people. There was the estate planning professor from the University of Michigan who passed away early. There was the head of the T&E practice group at McDermott, Mac Trapp. This is the kind of people that Phil was bringing in. There was only one big name that said, I'm too good for Miami, and he wouldn't come to Miami. Do you know who that was?
No.
James Kasner. Who else, So he couldn't get Kasner. So he had the first institute in 1966. And Phil's mission was actually very, very interesting. Okay, so now I'm going to talk about the early Sheraton Bell Harbor days. Now, I got all of these stories from Phil when I joined the Miami faculty in 1980. So this is all secondhand. Well, up until Phil died in 1983, this was his philosophy, because people were practicing estate planning without having enough exposure. And there were people who were using techniques in one part of the country and nobody knew about it in other parts of the country. Like he brought John Cohan in to do what was called estate freezes. John Cohan was a lawyer with Ira and Manella in Los Angeles. Now, unfortunately, all these people that I'm mentioning, unfortunately, most of them have passed away. But these were the giants in the field, and Phil brought in the giants in the field. NYU was still bringing in, people from the New York area and wasn't really reaching out to people from all over the country. And Phil realized if I'm going to attract people from all over the country, I should bring in names from all over the country. except he couldn't get Kasner. Well, there's no big deal. Okay, so, but Phil's idea was the profession wasn't getting the information. They didn't know what was going on in other parts of the country. Nobody knew about estate freezes in New York because it was done by Cohen in Los Angeles. And his firm was a LA-based firm with one office in Los Angeles and another in Beverly Hills or something. That's when Beverly Hills was like a different country than downtown Los Angeles. And so Phil's mission was to educate the profession so that they could practice at the highest level of competence. He wanted to make sure that people who are practicing estate planning had all the information they needed. That was his mission. And it was a training session. It was to teach people using Phil's philosophy of teaching principles and concepts and ideas, and not talk about how many angels fit on the head of a remainder interest in a Cupid.
Right.
So basically, it was. But at that time, it was known as the Institute for Advanced Training, because in the early days, if you went to the institute, there were no basics. It was all advanced concepts. Estate freezes, nobody knew about estate freezes. And you have to remember that also in 1969, the major legislation in the charitable area, because there were all sorts of charitable abuses going on, remember, charitable annuity trusts and charitable remainder trusts enacted in 1969 were nothing more than the same thing that was incorporated in 1989 into GRATs. You know, a charitable lead trust was the same thing as a GRAT, except the annuity interest goes to charity instead of being retained. So what happened is that it was a wonderful opportunity to bring the whole country together. And I think, and NYU was starting to do that, but, NYU did not have the advantage that Phil had. Miami in January.
Right.
Nobody from Minnesota is thinking, in the fall, I'm going to go to New York in October. But I'm going to go, in January, I'm going to go from Minnesota to Miami. That's a great idea. Now, basically, Phil wanted the profession to be practicing at the highest level of competence, okay? But not only did you have to be technically proficient, but he said, these are the people who are going to be making the laws in the future and are also going to be monitoring the profession to make sure the profession was honest. So ethics was extremely important to Phil. And Phil always had people talking about ethics. And he always would bring in somebody to talk about policy considerations as well. The problem with a lot of the CLE programs today, except the University of Miami and a few others, it's more technical training. What does the latest cases say and the implications of it, which is all well and good, but you have to add something extra. And so he would bring in ethics and tax policy. And that was unheard of in those days, because remember, at that time there was no mandatory CLE requirements and no ethics requirements. Now, Phil was also ahead of trends, because if you looked at all of the programs around the country, there was one unique feature of all the programs around the country which you don't see today. What do you think that was?
I don't know.
All the speakers were male.
Oh.
And Phil said, this is ridiculous, because the best hand-holders that I know are women. Men can talk about, husband, and you have to remember the 50s and 60s was a different era. And so Phil was the first national CLE program. NYU had a few people because, they had a lot of fine women lawyers like Ruth Shapiro in New York City. But Phil insisted that we have women speakers.
and he was ahead of his time, okay? Now, here was something interesting. Phil viewed the Institute as education for the profession, to make sure that they know what's going on, so they have all the new techniques, they know how to do all the new techniques, and practice at the highest levels. The Sheraton Bell Harbor only held 1,000 people in the big room, and there were no extra rooms. And the entrance to the Sheraton Bell Harbor was very small, and that's where he put the exhibitors. So he had maybe a dozen exhibitors. That's all he could fit. And all these other exhibitors were clamoring to exhibit at the Institute, because by that time, by 1980, the Institute was drawing 1,000 people. And people were clamoring to become exhibitors. But Phil kept it at the Sheraton Bell Harbor with limited exhibitor space because he didn't want the exhibitors to be a distraction for his speakers.
That is very interesting.
Yeah.
That is very interesting.
So as a result, the exhibitor space was very limited. You walked in, there was only one hallway, so it was a mob scene anyway. And so with limited exhibitor space, that means you had to go in and listen to his speakers and not be distracted by exhibitor's booth, okay? And what's also interesting, in the early Sheraton Bell Harbor days, there was no lunches, no breakfast, no dinners. Phil would not have anything to do with that. If you came down to the Institute, they had a continental breakfast for everybody, but lunch was on your own, but the hotel had sandwiches, and dinner was on your own. And Phil said, that's what I want. I don't want people to be distracted. It's good. Let them go mingle out. Let them go visit their grandparents in Miami Beach. At that time, everybody was in, your grandparents were in Miami Beach, and they would go to Junior's and the Rascal House and all that. Let them go there. That was what Phil said. Now, here's what's interesting, how I came to Miami, okay? So Phil kept hawking me to come to Miami and I said, Phil, I'm not really an estate planning lawyer. I've been teaching, true, I teach estate and gift tax, but I don't teach estate planning, and I don't know all this stuff. I have a nice conceptual course on estate and gift tax, but I teach partnership tax, corporate finance, mergers and acquisitions. I do accounting for lawyers. My specialty is partnership tax. This was in the fall of 1979. I said, why the hell do you want me to, I'm sorry, why the expletive deleted? Wait, let me, this is being recorded, right? Okay, I have to watch my language. Why the expletive deleted? See, that's politically correct.
Yep.
Why do you want me to come to teach in the JD program and the LLM program in estate planning when my expertise is partnership tax? And Phil's answer was, the estate planners are starting to use family limited partnerships for estate planning for discount purposes, and they haven't a clue of what partnership capital accounts are. And I want you to really teach partnership tax at the University of Miami Law School, and also communicate to the estate planning profession what partnership tax is about. Now, it was interesting, to Phil, everybody was a young man. Remember, young man, First Institute, he got this young guy, Mel Moron, who just, I think, turned 80. And Mel's here, of course. And so Phil said, there's a young lawyer in Houston, Texas, I want to introduce you to, who's starting to use partnership tax for estate planning discount purposes, and I want to introduce you to him. Now, who do you think that was?
That was Stacy Eastland.
Stacy Eastland. So Phil, what are the things that Phil did, which was fascinating, is he put together all these, what he called great minds and me, okay? He called me a little pisher. That's a, expression. And he put together people from all over the country to discuss concepts. And it was amazing how at the speakers dinner, I remember I was sitting there in awe because he invited me to the speakers dinner as a faculty member. I was sitting in awe at all these, intellectual giants saying, I don't know this. What do you think about that? It was fascinating. Now, here's what's interesting. So I joined the University of Miami Law School faculty in the fall of 1980. So I attend my first institute in January of 1981. And it's at the Sheraton Bell Harbor, and it's full. There's 1,000 people there. And I see everybody sitting there. It's all in one room at that time. And they're all sitting there listening to speakers. I listen to Covey. I can't understand too much. And all these speakers. So I start pestering Phil. Why don't you put me on the institute? And Phil said, well, Jerry, I don't know how you'll do in front of a big audience. Let me get you on a minor league program to see how you do. And if you do well in a minor league program, then I'll put you on the institute. 2 weeks later, this is Phil's idea of a minor league program. 2 weeks later, I get a call from Nick Liakis, who's the director of the NYU Tax Institute, who said, Phil Heckerling said to put you on the NYU Tax Institute. That was Phil's idea of a minor league program.
They were his warm-up band.
That was my warm-up band. So the next year, I'm on the NYU Tax Institute on a partnership panel. And on the partnership panel is myself, who no one ever heard of, okay, Ruth Shapiro, who is one of the leading partnership woman tax lawyers in the country, Richard Cohn, who is the reporter for the American Law Institute's revision of Subchapter K, and Larry Katz, who's one of the leading partnership tax lawyers out of Baltimore, Maryland, and me. So Phil describes the panel, and this is Phil's expression: 3 big machers and a little pisher. Wonderful, Phil. Okay. So now, at that time, NYU was in the Grand Hyatt, and there were like 1,500 people in the room, but it was a long, thin room, and in the back, you couldn't see the people in the back of the room because they were so far away, and the room was filled. And I'm kind of nervous because, this is the first time I've ever spoken at a major program, and I'm the last speaker. I follow Richard Cohn, Ruth Shapiro, and Larry Katz, who are all wonderful presenters, and everybody knows them. And just as I'm about to speak, nobody was in the front row, Phil walks in and sits down. And there he is, looks up at me, smiles. I look at Phil, and now I'm really nervous, okay? And so I start speaking, and fortunately in partnership tax, Ed Schlesinger just told me, here is how the key so everybody will think you're a good speaker. He gave me a little pep talk. Always tell people what page in the outline you're on, and therefore they'll think you're a good speaker. So I saw Phil, and I started speaking, and I did. 10 minutes later, I look over, and Phil's gone. And I panicked. Oh my God, he listened to me for 10 minutes, and he left. I must be a disaster. But I went on, and afterwards, I said to Ruth Shapiro, Phil left after 10 minutes. And Ruth said, didn't you know Phil is hard of hearing and he won't get a hearing aid? So what he does is he brings in his tape recorder, puts his tape recorder in, and then goes out into the hall to schmooze. So Ruth said, did he leave his tape recorder? I said, yeah. She said, you're okay. That was Phil. And so everybody, after I'm through speaking, which was fascinating, nobody comes up to me. Everybody comes up to Phil and says, Hesh did a good job. So it was like a bar mitzvah when everybody congratulates the parents. But the key is Phil had a vision. And his vision was something that was sort of to take the estate planning profession that was scattered all over, and nobody was paying attention to it except one day here and one day there at all these programs, and have just an institute for estate planning. Because if you were interested in estate planning, you're not going to go to NYU for 5 days just for one day. And it was amazing. And Phil always said putting on the institute was like putting on a christening or bris, a bar mitzvah, or a confirmation, a wedding, and a funeral, arranging a shiva call